You're scrolling Zillow at 2 in the morning, not because you're planning to move tomorrow, but because something inside you keeps asking the same question. Could I actually afford a house? Then you see it, a listing that looks almost reasonable. A $250,000 home. Compared to $500,000 listings, it feels refreshing, almost comforting. The photos look decent. The kitchen is older, but functional. The carpet isn't new, but it's livable. The description calls it an affordable starter home in a great neighborhood, and suddenly your brain starts doing math. If you make around $60,000, or maybe $70,000. Is that enough? Do you need 6 figures now just to buy what used to be called a basic house? That question creates a quiet kind of anxiety, not panic, just a constant background noise in your financial life. Most people believe homeownership is the universal symbol of financial success, the milestone that proves you've made it into stable adulthood. We've also been told something else, that once you find an affordable house, everything becomes easier. That homeownership is always smarter than renting, that if you can just get your foot in the door, you're building equity and securing your future. But here's what rarely gets discussed in those conversations. Affordable and possible are not the same thing. Mortgage approvals often give the illusion of safety. Banks look at ratios and say yes or no. They run your credit score through their systems. They verify your income. They calculate debt-to-income percentages, and then they tell you what you qualify for. But banks are not measuring your stress levels. They are not evaluating whether you'll sleep well at night. They are measuring risk from their perspective, not yours. Just because you qualify does not automatically mean the decision is financially comfortable. There's a difference between surviving a monthly payment and thriving in your financial life, and that difference determines everything about how home ownership actually feels. In dozens of U.S. housing markets today, $250,000 homes do exist. Cities across the Midwest still offer homes at that price range. Parts of the South, smaller metropolitan areas, rural communities with access to decent infrastructure. At first glance, that sounds encouraging. The median U.S. household income hovers around $84,000. That means many households are looking at homes costing roughly 3 times their yearly income. Historically, that ratio has been considered manageable. Financial advisors used to suggest keeping housing costs at 2.5 to 3 times your annual income. By that standard, a $250,000 home seems reasonable for middle-income earners, but modern housing costs include far more than just the purchase price. The financial threshold for comfort is determined by total monthly cost, not listing price, and that's where the story becomes more complicated. There is a mental shift that happens when housing costs cross a certain boundary. When your housing payment is manageable, life feels flexible. You can handle an unexpected car repair without panic. You can afford to take a weekend trip occasionally. You can contribute to retirement accounts and still have breathing room in your budget. Unexpected expenses feel inconvenient but solvable. When housing costs stretch your budget too thin, every decision becomes stressful. Grocery shopping becomes math. You're mentally calculating whether you can afford the better brand or need to stick with the cheaper option. Car repairs become genuine emergencies, not just annoyances. Even small lifestyle choices feel heavy. Can you meet friends for dinner? Can you replace your worn-out shoes now or wait another month? Should you skip contributing to your emergency fund this month to cover other expenses? This shift is subtle but powerful. It transforms housing from a place of stability into a source of pressure. Your home stops being a sanctuary and starts being a financial obligation that colors every other decision you make. And once you cross that threshold, it's difficult to reverse. You can't easily downsize. You can't simply walk away. You're locked into a long-term commitment that shapes your entire financial reality. Let's walk through the actual numbers, because this is where theory meets reality. A traditional 20% down payment on a $250,000 home equals $50,000. Most households do not have that level of savings. The median savings balance in America is far lower. According to recent data, many American households have less than $5,000 in savings. Some have significantly less, so most buyers choose smaller down payments, often around 10%, sometimes as low as 3.5% through FHA loans. While this lowers the initial barrier, it introduces additional costs, specifically private mortgage insurance. PMI protects the lender if you default, and it's required when you put down less than 20%. Let's say someone puts 10% down. That's $25,000. They borrow approximately $25,000. With modern mortgage interest rates typically between 6% and 7%, monthly principal and interest payments often land near $450, but that's only the beginning. Property taxes vary by location, but they can easily add $200 to $300 per month. In some areas, even more. Homeowners insurance often adds another $65 to $125 monthly, depending on the home's location and condition. Maintenance costs are commonly estimated at 1% of the home's value annually. For a $250,000 home, that's $2,500 per year, or roughly $200 per month. And that's just average. Some years you might spend less. Other years, when the roof needs replacing or the HVAC system fails, you'll spend much more. Private mortgage insurance, if you put down less than 20%, can add another $60 to $150 monthly. Add it all together. Total monthly housing costs can approach or exceed $2,100, sometimes significantly more. Now let's talk about income requirements. Traditional financial guidelines suggest housing should remain around 28% of gross income. Using that standard, households would need to earn approximately $90,000 annually to keep a $200 monthly payment within comfortable limits, but lending standards have become more lenient. Many lenders approve borrowers using a 43% debt-to-income ratio. Under those standards, you could technically qualify with householder income around $59,000. Here's the crucial distinction, that $59,000 represents technical approval, not financial comfort. It means the bank believes you can make the payments. It doesn't mean you'll have money left over for savings, emergencies, investments, or unexpected life events. Once someone commits to high housing costs, daily financial behavior fundamentally changes. Spending becomes cautious. Every purchase gets second-guessed. You develop a mental calculator that runs constantly in the background. Saving becomes difficult. You know you should be building an emergency fund. You know retirement accounts matter. But after housing, utilities, food, transportation, and other essentials, there's often little left. Emergency funds become slower to build. Instead of saving several $100s monthly, you might manage 50 or 100. Building the recommended 3 to 6 months of expenses feels impossibly distant. Homeowners in this situation may begin defining success differently. Instead of focusing on long-term financial flexibility and wealth building, they focus on maintaining monthly payments. Success becomes making it through the month without overdrafting. It becomes covering all the bills on time. Those are real achievements. They matter, but they represent a reactive financial life rather than a proactive one. Identity shifts from wealth building to obligation management. You stop thinking of yourself as someone building toward financial freedom. You start thinking of yourself as someone managing responsibilities. Your relationship with money becomes about constraint rather than possibility. Financial margin creates opportunity. Without margin, opportunities shrink. Households with leftover income after covering housing and essentials can invest in index funds or retirement accounts. They can start side businesses. They can relocate for better job opportunities without immediate financial pressure. They can pursue additional education or certification that increases earning potential. Households operating at maximum housing capacity lose that flexibility. An unexpected job opportunity in another city becomes impossible to accept because you can't afford to sell and move. A chance to invest in a friend's startup passes by because you have nothing available to invest. Professional development courses that could increase your salary remain out of reach. The cost of housing is not just money, it has also lost optionality. Every dollar committed to excessive housing costs is a dollar that can't work toward building wealth. It's a dollar that can't create future income. It's a dollar locked into consumption rather than production. And over decades, this compounds dramatically. The difference between someone who spends 28% of their income on housing versus 43% might not seem enormous in a single month. But over 30 years, accounting for lost investment returns and compound growth, that difference can easily represent hundreds of thousands of dollars in lifetime wealth. Many financial discussions focus on cutting small daily expenses, coffee purchases, subscription services, dining out. These conversations can become almost obsessive. People track every dollar spent on lunch or entertainment, trying to squeeze out savings wherever possible. But housing decisions often outweigh those savings dramatically. Choosing a home that stretches your budget can cost you $500 or $1,000 or more per month compared to a more conservative choice. That's $6,000 to $12,000 annually or more. That single decision has far greater impact than eliminating lattes or canceling streaming services. Large structural expenses shape financial outcomes, far more than small discretionary ones. This isn't to say small expenses don't matter. They do. But obsessing over $5 coffees while committing to housing costs that consume half your income represents a fundamental misunderstanding of financial priorities. The biggest financial wins come from getting the big decisions. Great. Housing, transportation, career choices, tax strategy. Once those are optimized, then the small daily choices can provide additional refinement, but not before. Housing costs can influence career decisions in unexpected ways. Individuals with tight housing budgets may avoid job changes due to income uncertainty. Even if a new position offers better long-term prospects, the temporary adjustment period or initial lower salary feels too risky. They may decline entrepreneurial opportunities. Starting a business often means irregular income initially. When you're stretched thin on housing costs, that irregularity becomes terrifying rather than exciting. They may avoid career shifts that involve temporary income reductions. Transitioning to into a new field sometimes means starting at a lower salary before advancing. But if you're already maxed out financially, you can't afford that temporary setback. Financial pressure can limit professional risk-taking. And professional risk-taking, when calculated and strategic, is often how people significantly increase their earning potential over time. The person who stays in a comfortable but limiting job because they can't afford income fluctuation often earns less over their lifetime than someone with financial margin who can pursue better opportunities. Over time, excessive housing costs can reduce both earning potential and career satisfaction. You become trapped not just in a house, but in a career trajectory that might not align with your actual skills, interests, or potential. One common mistake is focusing only on mortgage approval instead of long-term sustainability. People ask, can I get approved for this loan? Instead of, will this loan allow me to live the life I want? Approval and comfort are different standards. Approval means you meet minimum qualifications. Comfort means you have margin for life's uncertainties. Another mistake is ignoring maintenance costs. Homes require continuous repair, replacement, and upkeep. Roofs last 20 to 30 years. HVAC systems last 15 to 20 years. Water heaters fail. Appliances break. Paint needs refreshing. Plumbing develops leaks. These expenses rarely arrive predictably. They don't respect your budget timeline. They happen when they happen, and you have to deal with them. Buyers often calculate their housing budget based solely on mortgage, taxes, and insurance. They forget the ongoing maintenance reality. Then when the water heater fails 2 years in, they're caught unprepared. A third mistake is assuming income stability will always continue. People calculate affordability based on their current income and assume it will remain constant or increase. They don't consider job loss, industry changes, health issues, or economic downturns. Even in the best careers, income can fluctuate. Bonuses might not materialize. Commissions can dry up. Layoffs happen to talented, hardworking people. Building a housing budget that requires every dollar of your current income leaves no buffer for life's inevitable disruptions. Every financial decision carries an opportunity cost. Money allocated toward housing cannot simultaneously support investments, savings, or experiences. This isn't abstract economic theory. It's daily reality. The extra $400 per month that goes toward excessive housing costs could instead fund a Roth IRA over 30 years, assuming reasonable market returns, that could grow to several $100,000. It could fund a 529 college savings plan for your children. It could accelerate debt payoff, saving thousands in interest payments. It could create a substantial emergency fund that provides genuine security and peace of mind. When housing costs consume excessive income, the hidden cost is delayed wealth-building potential. You're not just spending money on housing. You're choosing housing over other financial possibilities. And unlike many financial decisions, housing is sticky. Once you commit, you're typically locked in for years. You can't easily change your mind and redirect those funds. Opportunity cost is rarely visible immediately. It doesn't announce itself. You don't wake up one day and see a bill for money you could have invested but didn't, but it compounds over time. And after decades, the cumulative impact becomes enormous. There's a specific feeling that tells you whether housing costs are truly affordable. It's not found in a spreadsheet or calculator. It's found in how you feel on a random Tuesday evening. Do you think about money constantly or occasionally? When an unexpected expense arises, is your first reaction panic or mild annoyance? Can you say yes to reasonable opportunities without extended financial analysis? Home ownership can be meaningful and valuable. It can provide stability, community, and the satisfaction of creating a space that's truly yours. But only when it supports your life rather than controlling it. The real question isn't, can I afford this house? The real question is, will this house allow me to build the financial life I actually want? Because true affordability isn't determined by whether you qualify for a loan. It's determined by whether your financial life remains stable, flexible, and sustainable after you move in. Whether you're building wealth or just maintaining payments. Whether you're creating opportunities or limiting them. Whether your home is a foundation for your life or a weight that holds you back. That's the truth about affordable housing that no listing description will ever tell you.